Hello, everybody, and welcome to our third webinar in our series of webinars. Thank you all for making the time to join us today. This webinar is really crucial and at a really good time of year because it's all about tax planning as we get into 30 June 2021. So Leisha and I are going to take you through a number of strategies on how to reduce your tax, grow your wealth, and increase certainty when it comes to tax and tax planning for your business. So let's get into it. Okay, so your webinar hosts, hopefully we're familiar to many of you already now. So I'm Teresa Allery. I'm one of the directors at Element Business and Accounting Solutions, and I'm joined by my business partner, Leisha Smaller, who is also a director at Element Business and Accounting Solutions. For those of you who are not familiar with the Zoom webinar environment, and hopefully many of us are now, especially with COVID, we've all moved to Zoom now. So this webinar is run through Zoom. Some of the Zoom settings that you may need to look at is the audio settings over here. So hopefully you can all hear us really well. Then we've also got the chat and the raise hand functions. Now we don't really use these functions very much. We may later on as we get better at it.
Only because it requires multitasking and we're just not
we're not there yet. But with practice, we will get there. So the one that you might find useful is the Q&A section over here. So if you have any questions throughout the webinar, feel free to pop your questions into the Q&A section there. And if we have time at the end, we will answer some of the questions. You can also click to leave the meeting if you need to leave. And you can just rejoin using your registration link. So over to you, Leisha, with the thought of the day.
Cool. So the thought of the day that we thought related really well to what we're speaking to you about is effective performance is preceded by painstaking preparation. Now, this is a quote by Brian Tracy, and many of you will know he wrote that book called Eat That Frog, which is all about fighting off procrastination. No one likes doing their tax. No one likes doing their tax planning. So what we fundamentally believe that by doing tax planning, it just what you put in, you'll get out, because we do a lot of profit forecasting, and so it avoids all surprises. There's another quote by Brian Tracy, which is successful people are simply those with successful habits. And again, we think that effective and proactive tax planning is an example of a successful habit for a successful business. So take it away, Teresa.
Thank you, Leisha. So the agenda for today. So this is what we're going to be talking about on our webinar today. The first thing we're going to start off with before we actually get into the strategies is why is tax planning so important? So we'll take you through why tax planning is important and why it's important to start it now. The next section of the webinar, and this is a smaller section, we'll be taking you through some key strategies for personal tax. Then I guess we get into the crux or the bulk of our webinar, which is running you through some key strategies for business tax. We're then going to do a deep dive into two key main issues. The first one is all about the importance of trust distribution resolutions. And the second one is how you can minimise tax using bucket companies in your family group. And we'll take you through an awesome diagram later on. It's awesome because I did it. Then we're going to talk about the way forward. So what are some of the services that we provide and what are some of the things that you can do for the way forward between now and 30 June? And then lastly, if we have some time, we'll go through some questions that you may have asked throughout the webinar. Before we move on, and I kept forgetting this in the practice sessions, but we are professionals, so we do have a disclaimer for you. Please just remember the information in this webinar is for educational purposes. It is not a substitute for one-on-one tailored advice to your circumstances. We're also going to be talking about a number of superannuation strategies. So it's important to note again that those are educational in nature. It is not financial advice. It is for tax planning purposes. If you would like to work with us one-on-one for some personalised strategies, please feel free to reach out. Over to you, Leishan.
Awesome. So why is tax planning so important? So I guess the number one reason is that you get to understand how much tax you need to pay up to 12 months in advance of actually having to pay it out. So you can factor it into your budgets and your cash flows. So none of this is a surprise. By doing tax planning, we can identify opportunities to minimise legally, not avoid, your tax, and we can help you implement strategies prior to 30 June so that what you are planning or what you're going to pay in tax has actually been strategically thought about. And many of the strategies we'll talk about today, where they come to money, it all needs to be spent prior to 30 June. Also, a lot of businesses may or may not realise that JobKeeper payments are actually taxable. So your normal operating business might be in a loss, but then if you've got all these JobKeeper payments coming in, then that might take you into a profit and you'll have more tax to pay than you may have thought you would. So that gives us an opportunity to let you know what that will be. Now, number 4, which we will go into a lot more detail towards the end of this webinar, is that we'll help you determine profits from trusts so that we can actually do the trust distribution resolutions prior to 30 June 2021 in this case, which is so, so important. And leading on from that, it'll also help us plan some dividend payments if that applies to you, all of which the ATO really want done prior to year end.
It's a big focus now for the ATO, isn't it?
Okay, Teresa. Yeah, there you go.
Okay, so let's get into some personal tax strategies. So there's 5 key strategies which we thought we'd highlight for today. There, of course, is many more, but these are some common strategies. These are the major ones and some common ones that you can implement from a personal tax perspective. So the first ones are all around superannuation. The first one being the $25,000 concessional cap. So every taxpayer has access to this deductible superannuation cap. For anyone under the age of 65. If you're over 67, then there's an additional work requirement that you need to meet. So what this basically means is you can contribute up to $25,000 into your superannuation fund and you can nominate to get a tax deduction for it in your personal tax return. So this strategy benefits mainly those people who earn at least more than $45,000 because that takes you into the marginal tax rate of about 34.5%, which is when this would be of most benefit. The next superannuation strategy that I wanted to raise was the carry forward contributions. So this came in from 1 July 2018 onwards. And what this strategy is, so people can make carry forward super contributions if they have a total superannuation balance of less than $500,000. So the carry forward super contributions allow members to use any of their unused concessional contribution caps on a rolling 5-year basis. So what does that mean? Let's think about it. So this means that if you don't use your full $25,000 superannuation cap in any of the 2019, 2020 or 2021 financial years, then you can carry forward the unused cap and use it within 5 years to claim additional tax deductions. It's really cool. So this would be really good if, for example, you have made a large capital gain in a particular year. You can bring those carry forward caps forward and get a larger deduction whilst boosting up your superannuation. The third strategy around superannuation for personal tax is a good one if you are on a lower income rate and you earn at least 10% of your income from employment, or if you are carrying on a business, then you can make a non-concessional contribution into super, a non-concessional A non-concessional contribution is one where you don't get a tax deduction. So you can put up to $1,000 into your super fund, and the government will co-contribute a maximum of $500 into your super as well, which means you basically get $1,500 into your super fund. So in order to get that maximum, your taxable income needs to be below $39,837.
Doesn't apply to many, but on the odd occasion, it does come in
it's
handy.
a really,
it is a
absolutely, it's free money from the government, and it boosts.
How often they give that out?
Well, lots lately, but it's true. It's coming to an end. It's coming to an end. So the next strategy for personal tax is if you have a rental or an investment property or a commercial property, then it's a really good idea to get a rental property depreciation or quantity surveyor report. And the reason for that is the quantity surveyor report gives you access to non-cash depreciation and capital allowance deductions, which is depreciation on buildings if they were built after 1985. Really good deductions in your tax return. The report costs about $500-600. It's also tax deductible, and it is well worth getting for the tax deductions you get throughout the life of your investment property, I guess. The third strategy for personal tax is all about motor vehicle logbooks. So these are painful. I've had many clients call me up and go, why am I doing this? And we always say, well, you can often get a really good tax deduction. So as an individual, if you use your motor vehicle in your income producing activities, whether it be salary and wages or running your business, then there's basically two ways you can claim motor vehicle deductions. So you can claim motor vehicle deductions using the cents per kilometre method, which gives you about a $3,400 capped deduction if you max it out, or you can claim depreciation under the logbook method. So if you're using your motor vehicle quite a lot for business, then the logbook method might be more beneficial to you because what it does, it establishes a business use percentage for your motor vehicle, and then you can apply that percentage across all your motor vehicle deductions, from fuel to RACQ to insurance, repairs and maintenance, etc., etc. There is a fair bit of, I guess, record keeping involved, but well worth the deductions at the end of the day. And then that motor vehicle logbook, you only have to keep it for 12 weeks. And it will last you for that particular vehicle. Only it's painful, but in the grand scheme of things, it will then last you 5 years unless you substantially change the use of your motor vehicle.
So just on that, the ATO monitor all motor vehicle purchases. So this is something that they will be cracking down
fairly
on.
New this has come in.
Yeah, so if you are going to use the logbook method, make sure you have a logbook.
Yeah, agree. Completely agree. Yeah. The fourth strategy is all around prepaying expenses and interest. So what we mean by this, let's say we'll go back to the rental property example. Let's say you have a rental property and you have an investment loan against that investment property. You can claim up to 12 months of prepaid interest in this financial year, but that interest has to be prepaid by 30 June in order to get that deduction. So other prepaid expenses that you can use this for, it might be property repairs, memberships and subscriptions. So really useful if you have the cash now. The last one is around work-related expenses, and it is a strategy, but it's also a reminder. And it's amazing how often people don't have invoices anymore. Keep invoices for work-related expenses without receipts. So without that documentation, you can only claim up to $300 in your tax return as a deduction without substantiation, which is not a lot. If you keep your receipts or tax invoices, then you can claim all your work-related expenses. That might include things such as training courses or learning materials, uniforms, tools of trade, etc., etc. One thing to remember when you're spending money to get tax deductions, well, I guess one important thing to remember is that often, apart from the rental property depreciation report, which we spoke about, you generally have to spend money in order to get a tax deduction. So your cash flow position is quite important when we look at tax planning strategies. Another important thing to note, and it is a common misconception, is if you spend $100 on a work-related expense, for example, you do not get a tax deduction for the full $100. You only get a tax deduction up to your marginal rate of tax. So let's say your marginal rate of tax is 39% and you spend $100 buying a book, work-related book, then your effective tax deduction is $39, being 39% of the $100. The rest you have to cash flow.
Yeah. I get asked that a lot.
Yeah, it's a very common misconception. Okay, over to you, Leishan.
So this is really a preamble to what Therese is going to talk to you about with business tax strategies. So to access these strategies, you generally have to be a small business entity. And a small business entity is one that has less than $10 million worth of income and, as the name suggests, is operating a business. So it can't be a business that has a rental property, but it might be a business that has several rental properties, for example, or just a normal trading business, which is really what it's aimed at. In conjunction with that, if you are a base rate entity, you are eligible for the lower tax rate. So for 2021, the tax rate is 26%. And if you are a base rate entity, that is an entity that has less than $50 million turnover and its passive income, so interest, dividends, rent, must be less than 80%. Otherwise, your company tax rate is 30%. And this will become relevant when you look at an example down the track.
Thank you, Leishan. Okay, so we're going to talk now about some business tax strategies around assets. So the big one we've been talking about a lot, and this basically came in as a response to COVID. It was firstly ignored, I guess, because people were worried about, what it meant when COVID hit. But we're seeing this being used a lot more now, aren't we, as things have settled down in the economy a little bit. It's something we're living with, I guess. So this is all about the temporary full expensing for asset purchases, or it's also known as the instant asset write-off. So the instant asset write-off is basically available for any business with turnover of less than $5 billion. And you heard me right, it's $5 billion. So that's the new asset. I know, well, it's a lot. That it pretty much would include pretty much all our clients. And I'm sure a lot of you out there as well. So if, however, your business has an aggregated turnover of less than $50 million, then you can apply this for new and used assets. Where your turnover is over $50 million, you can only temporarily fully expense assets that are new assets and not used assets. These measures extend beyond this financial year, and they will apply until 30 June 2022. So that's next financial year. For small businesses, a lot of small businesses will have small business pools. So that's where you basically aggregate all your asset purchases into one pool. So what we can do this year, we can fully expense the balance of that pool, which in some cases will produce some pretty large tax deductions for this financial year. One thing to note with the instant asset write-off or temporary full expensing, which to me sounds a bit more like it's more of a mouthful than instant asset write-off. One thing to note is, yes, you get full deductions this year, but when you go and sell that asset down the track, then the full amount of the proceeds that you receive for the sale of those assets will be assessable income in a future year when you sell. Another really common question we get asked around the instant asset write-off is, if I buy a car, can I claim the whole cost of the car in the year that I buy it?
Is that slide next?
It is.
Okay.
So yeah, it is.
Yeah.
So the answer to that is it really depends. So if the car costs less than $59,136, which is the ATO car limit, and you use that car 100% for business purposes, then the answer would be yes. However, if you have a luxury car, so let's say you go out and you buy that Lambo, and then you can Lamborghini, then you can only claim up to $59,136.
$250,000.
Yes, exactly. Exactly. And you'd have a pretty horrendous fringe benefits tax issue. But putting that aside, that is the answer for motor vehicles. So the next tax strategy around assets for business is similar to what I was discussing before for personal investment properties. Same thing, if you have an investment property in a business, it might be a rental property, it might be a commercial building, then again, we recommend this to all our clients, don't we, is get a quantity surveyor or property depreciation report. Because what that report does, it will list out all the fixtures and fittings within that property, as well as assess the build cost of the building, and you'll get ongoing tax deductions for those properties. Really, really worth it.
So we have it for our office. So we obviously don't own our office, but we fitted it out.
Yes.
So we get depreciation on the fit out.
Exactly. That's a good example. Good example. The last one that I wanted to talk about was repairs and maintenance. So if you're looking to make any repairs and maintenance to your assets and you do have the cash available to do it and you want the tax deduction before 30 June, then start making arrangements for those repairs and maintenance now, because that money has to be incurred before 30 June so that you can get the tax deduction. So this is a late addition slide. This is quite, Leisha and I were laughing. So we were driving home on Friday evening, which is why it's a late addition to this slide. After practicing this webinar. So we thought it was quite funny. Full disclaimer, Leisha was driving, I was photographing. We were not driving and photographing at the same time. And this car just happened to be in front of us. I don't know if you can see the number plate there. It says what tax. I don't know if you can see that. What tax?
Accounting brands. We thought that was hilarious.
Yeah, so we thought it was funny. So we were going, I wonder whether that person is going to claim the instant asset write-off for that vehicle. And I wonder if that vehicle is a car as defined for tax purposes. And if so, I imagine it's probably worth more than the $59,000. So have they limited it to the $59,000? And I wonder if they really use it for business purposes or not. But it's just laid on there like that. So we thought that was a funny slide to share with you because it's relevant. It's topical. Exactly.
Anyway.
Over to you, Leisha.
Okay. So from that to superannuation. So very similar, I know, but very similar to what Teresa was talking about from an individual perspective. We can also look at it as a business tax strategy. So again, you can maximise your deductible super contributions. The limit doesn't change for businesses. It's still $25,000. It includes superannuation contributions. So you be very careful that you don't exceed your cap, which is 25, like I just said, because it's pretty much horrendous. You end up with more assessable income in your own name and it's messy. So we just try and stick to that cap of 25,000. And when we go through our tax planning scenarios, we will look at superannuation being paid at a business level as well as an individual level.
To work out which is the best scenario.
So the second thing is quite easy, but again, you need to have the cash, and that is if you pay your employee superannuation before the 30th of June, you'll get a tax deduction for it this year. If you pay, because it's normally due on the 28th day after the end of each quarter, you don't have a choice as to one day later, one day before, it's the 28th day. But if you pay it beforehand, it is deductible. And so your June quarter payment is usually due in 28th July or on 28th of July. If you pay it before, you get the discount, the deduction for the whole quarter. If you don't have the cash, you might pay 1 month or 2 months, as long as the balance is paid by the 28th of July, you're okay. And if you're late, you've got to lodge those horrible superannuation surcharge documents, paid 10% for late payments. And it's, again, super, if not done properly, can be very painful.
No wiggle room,
the legislation does not allow for any wiggle room.
Very black and white.
Yeah.
So if you're even 1 day late with paying your super, it's not deductible. And that's just how super works. There's no discretion.
Yeah, well, it's not deductible, and you have to lodge those forms.
Yes. Yep.
And you have to pay that 10% until you lodge the forms and until you pay the amount. It's unforgiving. Oh, and the other thing I had to tell you was that if you pay through a superannuation clearing account and you want to pay before the 30th of June, you need to put your payment through. There's so many dates by the 24th of June, because it just takes that extra time to process through a clearinghouse. So just be aware of that.
And most of you probably will be using clearinghouses with single touch payroll.
Yeah, correct.
Yeah.
Yep. Sorry.
Okay.
Press the next forward button.
So the next business tax strategy slide is all about fringe benefits tax and how you can use it to your advantage. So what I'm talking about here is fringe benefit tax exempt tools of trade. So exempt tools of trade might include such things as portable electronic devices. This might be mobile phones, laptops, notebooks, etc. It also includes computer software, protective clothing, briefcases, tools
really
of trade,
stuff.
Yeah, etc., etc. So what an employer can do, and Leisha, you mentioned this before in our practice webinar, it's really relevant now with COVID and more people working from home, but you can salary package these items for your employees. If it's done properly and effectively, then what it means as the employer, you may be entitled to a tax deduction for the reimbursement payment to the employee for the equipment costs. As the employer, you can claim the GST input credit associated with these tools of trade, and the employee salary package is then reduced by the GST exclusive amount or cost of the computer, notebook, etc. So it is quite effective and quite topical now, given that so many people are moving to a work from home type environment.
Yes, they want to set up their home office. They might want computers, notebooks. Yeah, I know mine does.
Yeah. Okay, next chunky topic.
So Division 7A is one of those things that we bang on about year in and year out. And it's where generally you have a company and a shareholder, director or associate pulls money out of that company. Now, many of my clients will go, but it's my money. Well, it's not. It's the company's money. So the ATO want to make sure, they basically deem that to be a loan. The company has loaned you money. And so we need to ensure, as part of your year-end tax planning, that appropriate principal and interest repayments have been made, that there is a loan agreement in place, if that's to be the case, all the money is being paid back in full. If we don't do that and you don't go through that exercise, then you have an unfranked deemed dividend situation, and that just means that a lump sum just gets lobbed into your tax return, and there's, you pay tax at marginal rates on that amount. Now, when we go through and do your tax planning, you can either make your repayments in cash, or you can make it through a dividend. And again, we weigh up those scenarios when we go through the tax planning exercise. The ATOs, we're going to be talking about the trust distribution minutes that I spoke about earlier. So the ATO are also focusing on dividends, and they'll want them pretty much decided upon by 30 June.
Perfect. Thank you, Leisha. Okay, so some other key strategies for business tax. Leisha mentioned before in her slide small business entities. So small business entities do get certain tax concessions that other large taxpayers may not. And one of those is all around prepayments. So when you make a prepayment for a service, say, or for insurance, for example, a large business, you have to spread out the deductions for the prepayment over the service period. So if the insurance is for 12 months, then the larger business gets a deduction for the prepayment in time over the 12 months. For small businesses, however, if a small business makes a prepayment, it can get a tax deduction in full for that prepayment in the year that it is made. So that is a really good tax strategy to prepay things like insurance up front so that you get the deduction for it. Subscriptions is another one. Yeah, is another one. The next one is all about year-end stock take. So if you're a business that has stock, it's really important that you undertake a year-end stock take on 30 June. Small businesses, again, they do have simplified trading stock rules. And those rules basically say that if you think your stock is not going to move by more than $5,000 from the year before, you actually don't then have to do a stock take. However, it's best practice if you do a stock take, and we generally recommend it. So an important thing to remember with stock. So when a business buys stock, you don't get a tax deduction when you buy the stock. You get a tax deduction when that stock is sold. So that is why so many businesses now, you'll see it all on the TV and on the ads, stock take sale, end of financial year stock take sale. And the reason for that, we love it. You get some great bargains. I was on Harbour Town on the weekend. I got some awesome bargains.
Already.
Yes, they have. Yeah. So this is businesses trying to sell their stock so that they can get a tax deduction for the stock this financial year. I guess the other general rule of thumb really is the lower your stock, the more deduction you get. The third strategy is bad debts. So now is a really good time to have a look at your trade debtors or your aged receivables and have a look at those debts that you've been having trouble collecting or you just can't collect anymore, and work out whether you think you can write them off as a bad debt. So in order to get a tax deduction for those bad debts, the first thing is you need to have included it in your assessable income in a prior year. The second part of it is that debt actually has to be bad. So for a debt to be bad, it means that you need to have chased it to a point where it's no longer commercial or practical to chase it anymore. And the third part of it is that you actually have to write that debt off in your books on or before 30 June 2021. So what we also do for our clients is we will also do some bad debt minutes just to document that process. The fourth strategy is about varying down quarterly tax installments in your business activity statements. So this is a really effective strategy from a cash flow point of view. So if your income has changed and decreased since you lodged your last tax return, chances are you are paying higher income tax installments than what you need to be, and you don't actually get a refund of those excess installments until you lodge your tax return next year. So as part of tax planning, we will often look at the taxable income for a client and work out whether we can vary installments down now, because that means you have more cash in your pocket now rather than waiting to get that refund next year. Over to you, Lishan.
Okay, so trust distribution resolutions. I've mentioned it a couple of times now. So the ATO focus on this quite heavily, and we just want you to be aware that if your trust distributions minutes are not completed before 30 June, then the income of the trust can be assessed at 47%.
Yeah, and that's basically so the ATO say there's no beneficiary entitled to that income and therefore the trustee's tax.
Yep, so this is as opposed to the beneficiary. So if we do do our tax planning and we can streamline or make it, distribute income in the most tax effective way, you're going to be paying tax of 30% max, 47%. So what we need to do prior to 30 June is work with you to confirm an estimate of your trust income for the year. We review your trust deed and we consider the most tax effective distributions that we can make. And we use all the strategies that we've just talked about. Now we go on to Teresa's funky slide, because we're actually going to show you an example. And it's an example using a bucket company.
A bucket company is not a technical term, but it is a common term in the accounting world.
We'll talk about it all the time. So here we have in option 1, we have a trust with $250,000 worth of profit. And in this situation, we have dad and mum earning, we've distributed 50% each to mum and dad. Their tax on that 50% is $33,800, and the total tax, more importantly, is $67,600. Yuck. Then we introduce a bucket company. So now we distribute $90,000 to dad. He has a tax bill of $20.4K. We distribute $90,000 to mum. She's got a tax bill of the same amount. And then we distribute $70,000 to the bucket company, and it pays tax of $18,000 in round dollars. So the total tax for the group is now $59,000 instead of $68,000. That's a total saving of $8,600. That's for 1 year. So this will be year in, year out. Now, it doesn't come without its complexities. So Division 7A will apply. And you may enter into the pay-as-you-go installment regime, where you're paying tax quarterly. But that's okay. We have strategies about that too. But this is just an illustrative example of how we can streamline your distributions for a trust, because once we've decided upon that and you agree the ultimate tax amount, then we do a minute, you sign it, it's all pre-30 June, and you're done and dusted. You're all set. There you go.
Okay, so you've heard about a number of strategies now from a personal tax perspective and also a business tax perspective. So what's the way forward? So we've listed some of the ways that we can help you with tax planning. So the first one is a full tax planning service. And what that involves is an estimation of the 2021 profits for your entire group. What we do then is we consider what the best strategies are for your business and for your group to reduce and minimise tax. We then put together a pretty detailed tax planning report, which lists all the strategies, but it doesn't just list the strategies, it outlines the actual cash outlay you need to make in order to be able to get those deductions. Then we'll either have a meeting or a phone call or a Zoom discussion with you to run through that report so that you know exactly what you need to do to implement these strategies before 30 June. The second thing we do, if you have a trust that's earning profits, is, like Leisha mentioned in the slide before, is we can help with trust distribution resolutions and also dividend minutes. So trust distribution resolutions and dividend minutes must be done before 30 June. It's really important. We've mentioned it before, but it's worth mentioning again. It is an ATO focus. If you don't have that trust distribution minute in place by 30 June, then you are opening up the trustee to pay tax at the highest marginal rate of 47%, which none of us want. The third way that we can assist is with cash flow planning around tax payments. So we can calculate and estimate what tax payments you're going to make over the next 12 to 18 months so that you know upfront what you're going to be paying tax on, rather than at the end of the year and then you're trying to scramble to try and find those tax payments. So if you would like to know more about any of these service offerings, please feel free to contact us.
Cool. So now we've
got time
for questions. So we've got a couple here. Hang on. So if I bought a piece of equipment for $140,000 today, is it deductible?
Good question. So this really comes down to the instant asset write-off, which we were talking about before. So a couple of things that are important to remember if you're buying a piece of equipment. So let's say in this example, you buy a truck for $140,000. That truck must be used or installed ready for use by 30 June 2021. It also has to be used 100% for business purposes. If you use it less for business purposes, that's okay, but you only get a deduction proportionate to the business use.
Yeah, I've actually got a war story about that. So I used to do the accounts for a pub, and it had a whole stack of pokie machines, and they bought
very expensive.
Yeah, they bought $18 million worth of machines, and they were in a shed because they were extending where they were going to go in this pub. But because they weren't plugged in on site, ready and available for use, we couldn't depreciate them.
No tax deduction.
No tax deduction. Ouch. Big ouch. Yeah. And pubs make or used to make a lot of money, and they're the main poker machines are main income generators.
And then you can't get the corresponding tax depreciation deduction for them. Yeah.
Okay, do we have another one?
We do. Should I be paying myself wages out of my company or paying dividends?
Yeah, so I'll take this one. So I always look at it commercially first, but the answer really is always it depends, and that's what we work through our scenario. Because if you have mum and dad, it's very different if you have multiple shareholders and people working in the business, for example. And we might pay a dividend, and you might be able to get cash back out of it, which is
franking credit.
Which is awesome. Or we'll pay you a wage because it limits you. If you've dragged money out, we'll take it as a wage. So there's lots of opportunities because it stops the Div 7A situation from arising. But there's lots of things that you have to think about, like super on that wage and the timing of everything. So the sooner we do that, and STP is killing that. So all of this has to be done before 30 June, but it's just working out the scenarios and the best tax fit for that particular family group. Yeah.
So as in all tax questions, it depends.
I hate that, but yes.
It's a cop-out, but it's true. It is true. Okay, I think we have time, just checking the time. We have time for one more question. Okay.
Take this one.
Okay. So how beneficial is it preparing a motor vehicle logbook, and are there always tax benefits in preparing a motor vehicle logbook?
They suck.
They do. So did you want to take this one, or would you like to? Okay, sure.
So
okay. So I'll start off with the premise that, look, motor vehicle logbooks are super painful to prepare because you basically have to keep very detailed records of all your trips for 12 weeks. However, if you feel that you're using your motor vehicle quite substantially for business purposes, then it is absolutely worth keeping a logbook for your motor vehicle travel. If you are only going to use your motor vehicle sporadically for business purposes, so let's say you drive from home to work, that's personal. Let's say you go to a meeting here and there, but only a few times a year, it's probably not worth keeping a logbook in that situation because the cents per kilometre method will probably give you a better result. So again, it does depend. But if you feel that you're using your motor vehicle quite a lot for business or income producing purposes, then it is absolutely worth keeping a logbook, and it is worth the pain.
100%.
Yeah, agree.
Cool. I think that's
they're all the questions.
Yeah.
Okay, so in closing, thank you so much, everybody, for joining our webinar today. We hope you found it useful and we hope that you got a lot of value out of the webinar. When you exit, please complete the exit survey. We actually do read them. We actually really look forward to the results. We like to see what you write and how you rate us. It's really important to us. If there's any future topics that you'd like to hear about, please let us know. We hope we've given you plenty of ideas to ponder and some clear steps for you and your business moving forward. If you have any questions at all, feel free to reach out to Leishan or myself or our wonderful team. We're all here to help you, and have a wonderful afternoon. Thank you, everybody.
Thanks, everyone. See you later.